All right, if over the past few weeks or past few days, we've seen the Argentinian peso and the Turkish lira get pounded. Sure, they were going down beforehand based on what I was reading. But let's just read a little bit of it and let's just try to analyze why this is going on. But anyways, Argentina devalued the peso, allowing it to plunge the most in 12 years, and Turkey's lira tumbled to a record as the emerging market currency sell-off deepened amid slowing growth and rising social tension. The peso fell 12% to 7.8825 per US dollar today as Argentina's central bank scaled back efforts to support the currency. The lira touched an all-time low of 2.3029 per dollar, even as central bank intervention, or excuse me, as the central bank carried out its first unscheduled intervention in more than 2 years. South Africa's rand tumbled to a level weaker than 11% per dollar for the first time since the 2008 crisis. So basically, we also have some analysts, and let's just read what this individual says. People are trying to get out of emerging markets. Banhu Bavwijay, I can't pronounce that name, the head of emerging market cross-asset strategy at UBSAJ, said by phone from London, currencies are the weakest link in the emerging market assets. I cannot say that today is the day of reckoning, but more and more people pay attention to what happens to other emerging market assets. And it goes a little on and on about their policies. And if you want to just look at what's going on, I mean, I did a video last summer about India and potentially they could have a currency crisis based on what was happening with the Indian rupee. And it just seems, and I also mentioned that when the rates go up, you tend to see, when I'm talking about rates, talking about US 10-year treasury rates, right? When they go up, you tend to see problems in emerging markets. It doesn't necessarily have to be a correlation every time, but based on what I've read, and this is what Carl Denninger of the market-ticker has observed, whenever you see the 10-year rate goes up, you see dislocations in other emerging economies. And I could just show you the 10-year chart and just show you what's going on. So if you looked in the 1980s, right, we saw interest rates just go sky high. And there were problems going on in Latin America. Once these rates started to go up in the United States, you had problems overseas, and as a result, you tended to see all these Latin American countries. I think some of them were Argentina, and then there was Mexico, even though that's not, that's not a Latin American country. So you saw the rates go up, they tended to have problems. You go back to what happened in the 90s, right? You saw the 10-year rate, I think it must have gone to 7.8%. Let me check those numbers. So yes, I looked at the data again, and you saw, number one, these interest rates, they just spiked up in December, especially of 1994. And what happened in 1994? Mexico's tequila crisis in December, that same month where the 10-year rate hit 7.94%. So based on just some of these analysis that I've looked at, it just seems that whenever you see a huge spike up in interest rates, it hurts other emerging countries. Could there be something going on in the derivatives markets or behind the scenes where interest rates are just tied to activity all over the world and everyone borrows short, and then when those interest rates go up, then you're going to see an unintended, or you're going to see a victim out of that mess. I mean, some countries, it may not affect them significantly, but if you have individuals or banks dealing with loans where if their interest rates go up significantly, then someone gets burned. And Mexico in 1994 devalued their currency, the Mexican tequila crisis at that time. Now, if you want to look at later on in the decade, you tend to see some problems when it came to the Thai baht and also the Russian default scenario. And that event actually happened because the Russian situation, because the blow up of long-term capital management, a hedge fund. So, long story short, not all the currency events deal with higher interest rates or the rates going up. Because if you saw in 1997 with the Thai baht situation, where you saw a run on Thailand's currency, well, the interest rates really weren't going up to the extent like you saw in Mexico. But what does this say about central banking policies? That whenever you see interest rates being lowered, artificially lower, way below the market rate, this capital is going to go overseas, like you saw in Latin America in the 70s, like you saw in the emerging economies in the 1990s. You still had interest rates below the market rate, which eventually caused the tech bubble. And what does that mean for right now? I mean, what emerging markets do we see that are having problems? And you could look at, number one, India. When the rates started to go up, there was a run on the Indian rupee. And now we see a run on the Argentinian peso and also the Turkish lira. I mean, you have to remember, like last May, interest rates were, I think, maybe 1.48%. I don't remember the exact rates, but it was like 1 point something percent. And then what you saw was run on the Indian currency. I'm sure there were actions taken behind the scenes in order to prevent the run on the Indian currency. And I'm sure that there are also steps taken right now to make sure that the Argentinian peso and the Turkish lira won't get out of control. But you have to remember, it's a third world currency. It's not like a currency like the United States or Europe's currency, the euro, or the Japanese yen, where their debt is denominated in their own currency. So that gives Western countries a longer time frame than these emerging currencies, where their debt usually is not denominated in their own currency. Long story short, whenever you start to see just interest rates go up, right, like you saw in the 2000s to like 2007, you tend to see dislocations within the economy because everybody is over leveraged, and it usually creates, after like 4 or 5 years, some problems in the credit markets or in some currency markets abroad. 2006, 2007, or excuse me, 2007, 2008, we saw problems in our interbanking lending market, right? And that's what caused the problems to not be able to roll over all of these liquid securities into long-term illiquid securities, because just the rates just popped up. That was the problem. But now rates are starting to slowly but steadily go up, starting to see problems in the emerging markets. I think there's a correlation between that, because the Fed's liquidity is not going into those systems. They were, number one, helping them out through this easy money, and then you see rates go up, and then these countries are vulnerable because they cannot make it on their own, or they don't want to take the necessary steps in order to improve their problem. So that's something to note. This is what Carl Denninger observed, and he's been in the markets for a long time, so he is savvy to these items. So that's something to note. Now, what do I think they're going to do now? Well, like we saw in the 1990s, they had a lot of problems when it came to emerging markets. You got Thailand, and the 90s, mid-90s, you had Mexico. I think you had also Malaysia later on in the decade, Russia, and the long-term management problem, or whatever it was called, LTCM. Long story short, they tended to get their act together because there were deals done, usually with central banks or countries or the IMF. So I do think there's going to be some sort of IMF bailout or whatever to help these countries out, and then you could see a short-term market rally because of that. I mean, I've noticed that the traders that I usually follow, they're kind of freaking out right now. So when I see them freaking out, that means a lot of other traders are freaking out. So what does that mean? The IMF is probably coming up with some sort of plan to try to backstop this problem. Even though it's a short-term solution, they're going to band-aid the problem. I don't think it's going to be a long-term solution. So those are my thoughts, guys. Leave your comments below. I'll talk to you later. Bye.